opinions of Avenue 8. You should not treat any opinion expressed by Urban Hillsides as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of Urban Hillsides team's opinions. This video is for informational purposes only. All right. So without further ado, let me go ahead and bring Greg in. Hold on here. There he is. How you doing, Greg?
I'm good. I appreciate you both giving me some time to talk with you today.
Yeah. Well, you know, the story is we have a mutual client, and it was great meeting you a month or so ago, and it was nice seeing you work. It was nice seeing you work with them and our lender, and making a lot of sense for them. And we're still going through this process, so it was nice meeting you that way.
I would say from our perspective, that is what wanted us to bring you on, to see you interact with them and carry them through the decision-making process as it related to their potential purchase of a home. And that's great. I wish everybody had that. So that's why you're here, and hopefully you can help out other clients.
Yeah, that's a really interesting scenario, because I actually helped them purchase their first home. And so this would be a second home for them. And you can kind of see it go through the different phases, start to finish, and then back through the initial phase again with the second home purchase. So it's kind of cool. You know, the longer I'm working with people, like I have some clients that I've been working with for about 9 years now, and you really form a deep relationship over that time span, from career changes to scary situations to wins. You know, you get a mix of wins and losses across the board.
Yeah, and the similarity between real estate and financial planning is just the deep trust that a client needs to feel, and they're going to be more successful. We're going to help them be more successful if we have that strong relationship with them, and we sense that you had that as well.
Yeah.
Well, cool. You know, we did have a couple questions already set.
Sure.
We could just start there and see what you got to say.
Cool.
Right.
Sounds good.
All right. Well, you know, the first question we had for you was, tell us about the impact you can have on someone looking to buy a home.
Yeah. So that's a pretty loaded question.
Yeah, it's pretty broad. I know.
No, it's good. So really, I kind of see how I interact with people in real estate from a couple different perspectives. Like, there's the clients that are wanting to buy real estate, so they're needing to accumulate. And then there's the people that already own real estate, where they might want to make sure that they can keep their real estate because of a job loss. Maybe they have a remodel goal in mind. Maybe they want to purchase a different home. So that might involve a sale of an existing home. And then obviously, like, the downstream impacts of that sale can have big impacts from a tax standpoint, and just all the other finances. It kind of all ties together. And then there's also, how do I work with someone that wants to purchase a second home or an investment property? So each one of them need different type of planning. And, you know, really it all focuses down on, what are the goals at the end of the day? Like, what are the goals short and long term? And what have you been doing to achieve those goals, and are what you're doing now going to get you there, or should we make some changes? So we usually back into it from the goals first perspective.
Got it.
Yeah.
Darren?
Sure. So, and we always say this, and we heard in dialogue with you saying the same thing. The earlier you plan, the better. The earlier you start communicating, the better plan you can draft and work as you head into making a purchase or a sale or acquisition of some kind. How do you feel about that?
Yeah, 100% agree. You know, often I'm working with younger people trying to save for a first-time home purchase. I'm sure you both have been working with quite a few of those people purchasing homes for the first time, especially the last couple of years. But a lot of the times, where you're saving can have a really big impact. And for the longest time, up until last year, saving into a savings account was not the most productive use of where the money is going. So, you can get a lot more for a savings account now than at the beginning of 22, but you could also earn far more investing it properly in the stock market, and having a properly diversified portfolio could get you to that down payment in half the time, possibly, right? There's a really cool trick where it's called the rule of 72. And if you take the number 72 and you divide it by, say, 8%, so 72 divided by 8, it gets you what it would take, how long it would take to double your money. So you can use that as like an easy back of the napkin exercise to figure out, all right, I need 250,000 for down payment. I need 150,000 for down payment. I've got 75. If I get 1% return, it's going to take me this long. If I get 8% return, it's going to take me this long. And so you can do little exercises like that, but often we have a lot more at our disposal when you have someone that's looking at it objectively versus you're just entrenched in your own situation. You often are blind to what you don't know, and you might be going down a path that you think is right, but you never know until time has passed.
Yeah.
So you can't get time back is the unfortunate thing.
It's interesting. I went through your website just a little bit, and I thought it was funny how why you need a financial planner. And one of the points was you need somebody to blame. It was something along those lines.
Yeah, I can
Are
facilitate.
you volunteering that right now?
Conversation. Yeah, I'll be the scapegoat. Just blame it on me. Greg said we needed to save more. It's okay.
I think when a lot of people come in, and particularly first-time home buyers, maybe if they don't have that lump sum or huge down payment, it's just daunting. And if they can speak with somebody like you in advance, and feel like they have a plan to get there, that will inspire them a little more, I believe.
Yeah, I see it a lot with a lot of people, especially West Coast based. There's a lot of people I work with that are in the tech space, so their most valuable asset might be their company equity, for example. And figuring out how to unwind that and how to tap that asset can be a challenge. And most people don't. And then it becomes, it's a single asset. It's like, all right, you own a bunch of Apple stock. It might have done really well for a long time, but now your income and your investments are all tied to one company. Your risk just goes through the roof that way. And you can, if you have enough time, you can unwind that position and diversify away and essentially lock in those gains and the value that you've created. But there's little tricks and things you can do to help offset the potential tax implications of doing the sales of that asset too. There's a lot of little things that you can do over a period of time that don't just say, all right, we're no longer doing this, we're only doing this. It's kind of, you want to be doing both probably. So
Got it. Makes sense. And obviously each person's case is individual and really needs a custom plan put together to navigate it.
Yeah, and there's always going to be wild card, weird things happening. You're going to have one plan and then it's going to get flipped on its head at some point. So at the end of the day, you always want to be thinking, if I'm going to be doing something, how do I do this and also build flexibility? Because the situation is inevitably going to change. And if you have flexibility, then you can just pivot, right? You want to be failing well. Like, I want to be failing and still be better off than now. Right.
Right. And a better term for flexibility than what I always seek in many decisions, particularly financial decisions in life, is options. Right. That's you're not honed in and stuck moving in one direction. You can adapt then if you're in that position. That makes sense.
Yeah.
So give us an example of.
I was going to say that's kind of the next question, right? Example of the creative home buying process you've been through in the last 2 years or whatever.
Yeah. I feel like I've had a couple. one of the more recent ones is they have cash for a down payment. They need a little bit more, but the bonus that they're going to use for the little bit more isn't coming for 4 or 5 months.
Mhm.
Okay, well, what do? we need to put an offer this week. Well, there's an investment portfolio they have. If they liquidate that, there's a taxable impact on liquidating. So they need to come up with about 60 grand of capital for the down payment to be able to make it through. They're going to have a bonus of about 100. Nice situation to be in, right? So we have the ability to borrow against assets too. So taking what's called a collateral loan against their investment account for a short period of time. It's kind of like a line of credit. You could do the same thing with a margin account, for example. It's a short period of time. It's a Band-Aid, essentially. And the goal is, all right, we need capital today. We don't want to liquidate our investments. We'll pay back that collateral loan with a bonus. So, yeah, that's an example of one. Another example that this actually happens, I'm sure you see this fairly often. Someone is ready to buy a house, and they've some random thing and random missed payment, or for a while it was a lot of like random missed medical payments would ding their credit in the final hour. The 11th hour, we're locking in our rate, and there's the bill that was missed from the cable box that wasn't returned, right? Oh, well, now my credit score is below 700 when it was at 730 before. All right, well, what do we do? Well, that's when obviously try and resolve the issue with the credit score as soon as possible, but that might be working with the lender to figure out what's an alternative loan that we can get for the short term to then fix it when the credit's back to normal in the future. Not pigeonholing yourself to like, all right, this is the only way we can do it to get this thing done. It's understanding like this is flexible. Like real estate purchases are big, obviously, but there are things you can do once you've made the purchase that will negate the previous things, right? You can refinance, you can do different things with those loans to restructure them. So if the goal is I need the house and I'm really excited about this house I want to live in, this is my future home for a long time, being nimble can be really valuable.
Yeah, that's great. What about that car purchase 2 days before closing? No.
Yeah, you don't want to purchase yeah, I actually just had a client, she purchased like a used car. It was like 17.5% interest rate. I was like, why didn't you just call me? Like, we have options. So yeah,
that's the one thing that all lenders were saying. Don't go out and buy a car once you start this home buying process.
Yeah, the impact of a car loan, even like a small one, can be pretty big, right? Because of the leverage on the 30-year versus a 5-year car loan or something.
Yeah, it's hard for people to grasp that what a lender is really looking at are their monthly costs, not even their overall debt. They can have $20,000 in debt, and if their payment's $5 a month, that's what they're going to look at. If their payment's $600-$700, like a car typically is by today's standards, that's what they're going to see, and that will really impact their purchase power.
Yeah, it does. It's not one for one. It's like a multiple of it too.
Yeah. Well, tell us
think
about.
go ahead,
Jeff.
No, go ahead there.
So, in working with investors or people looking to transition and dealing with investment properties, how do you help out with that realm of the business and planning?
Yeah. So a lot of our client base, young entrepreneurs, business owners, about 75% are under 40 years old. I do have people that work in real estate specifically, and some of their primary goals are, I need some traditional things so that I can stack away as much money as possible. So then when an opportunity comes around, it's available for me to use it. So we use taxable investment accounts all the time as a way to save, build up wealth, and then deploy that capital into opportunities. So it's liquid, obviously. But there's tax consequences of selling, but those could be positive or negative. You can use the money from the account to pay the taxes. But I have real estate professionals that specifically do that. I have people that have real estate existing, and then they use their cash flow from those properties to funnel into investment accounts, and then use that money, grow that money as fast as possible, and then use that for another purchase. That's a creative way of building up your money and having it available to be able to use for other opportunities as well. Yeah, those are probably two of the most common. And then there's obviously the notion that people want to be able to diversify their existing real estate business. So, we're doing more traditional investing. And there's ways that we can sometimes balance out a larger real estate portfolio. It's not always up and away, right, on real estate.
Sure.
So
What are you talking about, man?
yeah, definitely. If you've looked like only in the last couple of years, it seems that way. But so like real estate's one asset class, and you can have dozen other asset classes that help balance out that asset class in itself. Often when we're planning and we're working with someone, especially that has multiple properties here in California, those could be worth a lot. So we can actually build portfolios that exclude real estate from their investments. So then they're not unknowingly overweight and own a whole bunch of real estate and not even have an idea. Like they just know, all right, I own these properties and Greg's managing some other accounts for me. But maybe those other accounts, if we aren't managing for real estate, own also another 5 to 10% real estate. Well, then all of a sudden, if it takes a dip, their wealth is dropping a lot worse than had they not owned it at all.
Sure. And what you mean there is, if a part of their portfolio is invested in like a real estate investment trust tied directly to the market. Yeah.
Yeah. Publicly traded real estate investments. There's a lot of them. There's hundreds, if not thousands out there. And there's some investments, especially like index funds, where they can exclude those.
Right. Understood. Yeah. And you're on a real estate show, so we support 100% real estate all the time, man. I just want to point that out. No, balance is absolutely key. I've been real estate for an owner of real estate for 25 years now. Yes, and been through a couple cycles, and it feels good to have other assets when it's down. Yeah.
And sometimes it's hard to get your money out of real estate sometimes. So, we have the ability to create accounts that are liquid, right? It's not so easy to get money out of your property, especially when interest rates are high. You can't just refinance to pull money out.
I think we find that most people want to get their money out of real estate when it starts dipping and they want yesterday's price.
Yes.
That's a very common scenario.
Human nature.
Yeah, it's the long game. Real estate is long-term investing works both ways, real estate or traditional. You got to have a long time horizon. The longer the time horizon, the higher the likelihood you're going to be successful, for sure. And it's expensive if you have to force sell real estate, right?
Yes. If it's done without time, it works against you. Absolutely the case. Yeah, I agree. Yeah.
Yeah.
All right, Joe, what do we got next?
It seems like we've hit a lot of the answers to the questions that we had already
Great.
preset. We started going into this. People don't know what to do with their money after a sale, and we were asking you if coming into a lump sum for a sale, and they can't do a 1031. How do they avoid taxes? Can you help? Because a lot of sellers are resistant to selling because of this challenge.
Because
they
of
don't
that.
have they don't have the answer.
Yeah. Yeah, the 1031 challenge is tough, especially when it gets to be big. I have family I've told you both this, a family that they invest in real estate, and the 1031 exchange can be really valuable, and then it becomes this thing that's too big, and you don't want to realize the gains. But sometimes realizing the gains isn't all that bad. We know today what capital gain rates are. We know exactly what you're going to possibly owe. It's going to be, working with an advisor, you're going to be able to figure out, all right, what have I put into the property? What are all my expenses going back in time? Build a spreadsheet, start consolidating all the things that you've put into the home that help add to the cost basis. All that stuff helps a lot. And then when you do the math, figure out, all right, if I do this, then this is what my potential gain could be. And then look at all the other assets that you own. What do you own that is maybe at a loss? And then maybe you can match some losses with that gain from the real estate and balance them out. Everyone is coming off of 2022 with losses. We know this. And especially anyone that owns crypto, there's been a nice little run up recently, but we're still 70% off of the high. So you probably have really big losses that you could realize and then use that capital loss to offset your real estate gains. Like, those can balance each other out. And there's a little loophole right now with crypto, especially. You could sell and then buy it back the next day, and there's no wash sale rule. You don't have to wait 30 days. And that's a little loophole that's likely to close at some point.
That's amazing that it still exists.
Yeah, it's crazy. So if you're sitting on losses, you could just sell and then buy it right back, and no time has passed. But with stocks, equities, there's a rule where you have to wait 30 days to buy back the same security. So a lot can happen in 30 days if you're trading. But it's a way that you can balance out these gains and losses. If you think of it like a funnel, like your taxes are kind of like a funnel, right? Everything comes in, comes flowing down. No matter what the input is, it's always going to flow to you as a person for your tax return. And you can use like a T-chart, do your gains and losses short and long, and just go down the list and balance them out. And then you get your bottom line number. And it can be really helpful to do that. Realizing the capital gain or the loss isn't always a bad thing. You can carry losses forward too. So if you took a loss 3 years ago and you haven't realized the whole thing and wiped it out, you could keep using it in the future. So those are all little things that can go a long way, especially if you sell a home 4 years from now and you realized a loss last year. So those are all things that factor in together, and they play a big role. Another piece to selling, what do you do with the money once you bring the money back into your bank account after the sale? That just goes back to the goals, right? Do you need to purchase another? Is your intention to not purchase another home? Are you going to rent for a little while, maybe in a new place? Well, parking the money in the right location and making sure it's invested properly all goes back to, what are the goals? Do I have my emergency reserve established and set up properly? What's my cash flow look like? And then you can start figuring out the more offensive things of maybe I want to invest a portion of this.
Very good. See, I think
Yeah.
again, when you really break it down, understand the overall financial picture, and if you do it in advance, planning, maybe you're intentionally taking some losses in the stock market, liquidating that to offset gains on a real estate sale, as you're mentioning.
Mm-hmm.
If it's planned out, it's not as daunting. Maybe it's not as bad as you think. Capital gains is a
Yeah.
lower tax rate than income is.
Yes.
Yeah. Well, that's great.
Yes. Yeah. That is a good point, actually. You know, 15 or 20% is quite a bit different than, federal and California stacked on each other. You're up in the 40s real quick,
Yeah.
right?
Yeah.
So, yeah, it's not all that bad. I think really the key though with selling and having gains or losses, making sure you're long term on your capital gains is going to be or losses is going to be
Right.
really important. Um, yeah,
And long
especially
term is the benchmark
1 year.
1 year. You have to hold the asset
And
for 1 year. Yeah.
yes, exactly. And then obviously for real estate, that 2 year as the primary is going to be really important. There's probably a lot of people sitting on a lot of gains, and I personally have a friend that bought a home in San Diego, uh, traumatic increase in value, new job opportunity, moving to the East Coast. So they had to sell their home inside that 2 year mark. But they were able to still use a portion,
Yeah.
because it goes by month, a portion
Right.
of their exemption.
Yeah. There
So
are
they
unique
didn't get the
cases.
full, yeah, they didn't get the full 500 exemption, but they were able to use a good chunk of it. I think it was close to 75% of it, and that really ended up saving them a lot of money from a tax standpoint from the gains.
Yeah. I had
Yeah.
one more question.
Yeah.
What's your feeling of inflation? It's a big topic. Been around. I've been talking about it for well over a year now.
Yeah.
What's your perception of that? How is it relating to investments? How is it relating to real estate? What's the long term history of inflation compared to real estate?
Oh yeah. Yeah. Inflation's tough. Um, it's real. We kind of didn't have any for a long time, and we have a very short-term memory of what it actually is.
Right. Right.
And so, like, when you don't have it, it's never an issue. Um, my generation, millennial, we've never really had to deal with inflation. I remember when gas was like in the low dollars, like 125 when I was in high school. But like, you know, that's a really sign of the times, obviously.
Yeah.
But inflation's real. Loss of purchasing power is very real. Ask anyone that has been sitting on the sidelines wanting to get into real estate the last decade. Maybe they got burned really bad from the '08 recession, '08 and '09 recession. They might still be on the sidelines, and now they're priced out and they have to wait for the next cycle. And so that's a perfect example of like either you're in it and you're with inflation, or you need your money to be growing and outpacing inflation. And
Right.
there's no better way to do that than investing that money properly, because that erosion of purchasing power is real, very real. So
And,
yeah,
and almost impossible to catch up on if you've been sitting on the
yeah,
sidelines for too long.
yeah.
Uh,
You need a lot of things going in your favor. You need income to be rising faster. You need your expenses to stay exactly the same, and you need a couple random bonuses to get you up ahead. It's tough.
sure.
It's really hard. Um, there, inflation though, like kind of goes in waves, right? Um, we've had a dramatic drop of inflation the last 6 months. But because we're measuring a year back, it's kind of clunky the way we measure inflation. And it's like the headline figures are not really what we're all feeling in reality
Day to day.
oftentimes.
Yeah. Yeah.
Yeah. Like we all have different reality, and it's weird comparing something from a year ago, and really we shouldn't be measuring it like that. That's not, this is a more fluid thing, and it's an awkward measure. And so, but it's just hard. There's too many inputs sometimes, and the economy is a very complicated thing, and we're trying to make it not complicated with inflation numbers.
Right.
Yeah.
Well, we say, getting into your first house is hard. It's very hard. It takes a lot of effort. It's scary. It's a huge debt to take on, huge responsibility. But once you're in, the volume of benefits that come along with ownership, and I personally believe, if you look historically, it is a bit of a hedge against inflation. That if you get in at a fixed number, as inflation is moving, your payment's not moving. There are other things to deal with. It's not like it's an asset class that is carefree. You have to deal with repairs and maintenance and taxes and all that stuff. But the benefits are huge. And it becomes many people's access to capital well into the future, to do other things in their life as well.
Exactly. And the one of the cool things about real estate too is it doesn't matter if you're buying a home for $100,000 in Kentucky or you're buying a multi-million-dollar property in LA. Like the emotional benefits that those two people are feeling are probably very close, right? And they're on the same page. Like they're both getting the same thing out of that, right? They're both paying a little to the bank and a little to themselves in equity, and they're taking pride in that ownership versus being annoyed that their landlord hasn't come to fix something at their apartment. Right. So there's a lot of things that come out of it, but the hardest part is getting in. The lending standards have gotten tighter the last decade since the last recession, but there are still lots of ways to be creative, I think, and to be able to get into a place. And really, I encourage people to go below 20% for a down payment if their job situation is very stable and there's dual income, as well as having all their other stuff in order, right? Do you have 3 to 6 months of emergency reserves? Do you know how to save? Do you know how to budget? Like, are all those things understood? Because if they're not, well, like maybe taking out a big investment into a real estate property and in doing that isn't the best thing, right?
Yeah.
So, yeah.
Well, cool. Joe?
I think that kind of ends it, doesn't it? I think that's where it ends.
There, we could talk. I could talk for hours.
Real estate is a hedge against inflation.
Can be, yes.
Yes. Well, gosh, man, thanks so much for joining us today.
Thank you. I appreciate it.
If we do have a small audience with us right now, what would you say to them if they wanted to engage you? How does that process work?
We're really casual. I've got a team here in LA. We're all remote. We do a lot of virtual meetings, a lot of phone calls, meet in person if need to. But usually a 15 to 20 minute phone call is a great way to get to know each other. This is not transactional by any means, so it's all relationship based. It really kind of depends on if we click and if we get along. But you can reach out to me directly from the website. You can email me. You can call me. We're available a lot of different times, and usually a good place to start is just an intro. Have a phone call.
Right.
Talk for a little bit. Yeah.
And Darren, when we met earlier this morning or last night, I think there are probably some other topics that we might return to. Right. I know we started talking about 1031s. That might be another next session with us. So.
I'd be happy to come on again and maybe we could get into the weeds a little bit if people are interested and go over like some specific examples or something.
Yeah. Awesome.
Yeah.
For the people that are on, if you have any questions, let us know. We'll pass them on to Greg later, and he can answer them for you. Okay.
Awesome.
All right. Good. Thanks so much, Greg. We'll talk to you later.
Yeah. Thank you both. Thank you.
Thanks for your time, man.
Be good. All right. Well, that worked out really well, man.
Yeah.
I like that.
Yeah.
Yeah.
It's great. So much, man. I get excited about this topic because I come from that background with parents on the financial side. And, it's to me, it's just financial independence equals freedom. That's really all it is, man. And I want everybody to be free to do as much as they can from